Investment banking is currently grappling with a technology discontinuity that is fracturing the industry's foundations from the bottom up. The core work product is unusually susceptible to automation. Pitch books, information memoranda, and complex valuation models follow templates and formulas that have remained largely static for over 2 decades. This creates an immediate economic pressure. In a typical bulge bracket bank, employee compensation accounts for 55 to 60% of total expenses. Look at the firm Shape. A managing director sits atop a pyramid of vice presidents, associates, and 16 analysts. AI automates that bottom tier, dissolving the base. The firm compresses into a narrower diamond shape. The middle layers shrink, leaving a leaner, top-weighted structure. AI acts as a structural wedge, driving a permanent shift in the margin profile of the firm. Despite the noise about automation, a purely AI-only investment bank will not exist for the foreseeable future. Large corporate mandates are won on relationships built over decades. These are multi-million-dollar bets placed on trust, a commodity AI cannot manufacture. The regulatory environment reinforces this. Agencies like the Federal Reserve require a registered, accountable person to sign off on every transaction, ensuring there is a specific individual to hold liable if a mistake occurs. These regulations function as deliberate features that institutional clients value to ensure liability and safety. The result is a split reality. AI hollows out the middle and bottom layers, while the top tier remains shielded by regulatory and relationship moats. Instead of being captured by a single tech entrant, the industry itself is fracturing into 3 distinct configurations. Success depends on identifying which of these 3 structural paths maximizes your specific return. Path 1 is the incumbent transformation. Bulge bracket banks like Goldman Sachs and JP Morgan are using AI as a scale multiplier to extend their dominance. Their advantage is proprietary data. Deploying private models against 30 years of deal history creates an unreplicable barrier to entry. This data compounds. Retrieving against internal archives produces higher quality outputs, causing margin potential to spike as analysts become more productive. Leadership at these firms, including Jamie Dimon, have positioned AI as a top capital allocation priority to protect this competitive edge. However, they face massive friction. Regulatory frameworks like Fed Letter 11-7 require complex model risk management that adds layers of internal bureaucracy. This leads to overgovernance. Internal tools often become so restricted and clunky that top-tier talent grows frustrated with the platform. The real threat to an incumbent is a top managing director realizing they no longer need the bank's massive analyst pool and deciding to leave with their clients. That brings us to Path 2, the AI-native boutique. These are lean, 20 to 60-person firms formed by elite defectors from the bulge brackets. They target the mid-market, deals between $50 and $500 million that big banks underserve and traditional boutiques serve at a high cost. The matrix shows their efficiency. Pairing senior bankers with tech founders lets them use off-the-shelf AI to replace the analyst pyramid, keeping capital requirements low and maximizing fee retention. However, without an existing compliance department, their regulatory risk is significant. Founders must build a broker-dealer and compliance substrate from scratch while surviving a 2-year runway before meaningful deal revenue arrives. In this model, an AI platform allows a 30-person team to structurally compete with a massive global firm. Path 3 is the infrastructure play. These are the tech builders who sell the picks and shovels to the other 2 groups. They build vertical-specific tools like compliance monitoring, information barrier retrieval systems, and analyst augmentation layers. Every firm in Paths 1 and 2 is a customer. This path offers high market demand while completely sidestepping the regulatory burdens of the financial industry. By avoiding banking regulations and relationship dependencies, they lower their risk, but they also lower their ceiling. Infrastructure players trade the massive multi-million-dollar fees of M&A advisory for more predictable but smaller software margins. For technology-first entrants, building the unsexy compliance layer offers the highest risk-adjusted return in the market. Identifying the right strategy depends on your current professional leverage. Institutional leaders should focus on incumbent transformation, using their data and relationship scale to multiply reach. The primary risk is talent flight, dealmakers leaving when they realize they no longer need a massive junior staff. Senior bankers with strong client networks should pursue the AI-native boutique, though they must manage operational risks in building a new firm. Tech builders seeking high-probability returns should aim for the infrastructure layer, focusing on the compliance substrate every bank will eventually require. One core technology, the enterprise AI platform, is creating 3 distinct and highly profitable business models. In banking, raw speed or the most advanced algorithm rarely guarantees a win on its own. Right now, we are watching the industry's traditionally rigid structures rearrange themselves to fit new, invisible currents of change. The ultimate winners will best translate AI capabilities into the strict confines of financial compliance. Investment banking is entering a period of structural fragmentation, still rooted firmly in human trust.